The Rebel Capitalist Show. So let's move over to cryptocurrency. And sometimes all you can do is laugh. I did a couple videos on Shiba Inu, whatever it is. And to think that you could have a joke crypto of
Derivative
another
joke.
yeah it goes up to a $50 billion market cap. I mean, can it get any more insane?
I think the second or third piece we ever wrote was every Doge has its day. And I know we write about what's in the news, so I don't want to keep saying like, oh, we've written about that, but we've written about that. And
Yeah.
we when our take on it was, we spent a lot of time thinking about what was it like to be in Weimar during hyperinflation. What were the people thinking? The
Great.
boiled frogs, as we would call it. Like,
Great.
how could they not know? And we see all these things around us. And I wonder, like, what does this mean that Dogecoin is got 100 billion market cap, if market cap is even the proper way to express it? People are expressing, I believe. So, like, again, just because I don't understand it doesn't mean it's not important. It doesn't mean that I shouldn't try to understand what the signal is telling me. So people have such indignation that Dimitri Kofinas of Hidden Forces is another podcast host.
He's great.
He's labeled this market nihilism, where you know what you're investing in is worthless, but you do it because it's worthless, and you assume someone else will just buy it from you. So I think there's an important signal from these market extravagance that, we as value investors, the Austrian School of Economics, believe me, like we like to say here, we earn in fiat, we save by buying real assets, and we invest privately where we can affect the outcome. I don't trust any of it. I could never buy that coin. If you told me this coin has an 80% chance of tripling tomorrow, I don't even know I could pull the trigger, because I can't buy it. It doesn't compute with me. But there's a whole army of people for whom all they need is another fool, and there's plenty of fools. Well, what does that signal? That signal could mean the market is expressing that the currency will soon be worthless. Yeah. Now, I'm not saying that's what the symbol means, but what that signal means. But it's one possible outcome. They have such little regard for either the currency or their hopes in the future to generate more that they YOLO trade into the next hot thing, knowing that it's worthless, but assuming they can get out, or this is their very best chance to make it. Back to your 100 people in your workshop, maybe this is their workshop. Like, I can YOLO trade and I got a chance. It's like a scratch lottery ticket. And it's mind-blowing to me. I could never invest in it. I would separate sort of the technology of crypto from the speculation of the tokens, because I think they're actually two very different things.
Yeah. And I separate Bitcoin. When I talk about crypto and Doge, I'm not talking about Bitcoin.
We're just talking about raw speculation, tulip style. And
right.
It's the one of the things we write a lot about, what we worry about with inflation, is for the first time ever, we have this integration of wildly uncontrolled social media that injects a level of fervor into all of these events that has never been experienced before. And one of the things we worry about is, if inflation is driven by inflation expectations, that same social media fervor could be whipped up about inflation by people who don't like us, because social media can be manipulated, as we know. And inflation expectations could be manipulated by, take your favorite foreign actors that don't like us. And, one of the things we write about is, when the first Big Mac, the first $20 Big Mac goes viral on TikTok, does that not contribute to inflation expectations? And could the social media part of this new game, which I guarantee you the Fed has no ability to model, let alone understand or know that it even exists, if Doge could be worth what it's worth, or Shiba, the derivative of Doge, can be worth what it's worth, that's just proof that people could be manipulated into thinking something on a vast scale that matters. And so
that they have to go so far out the risk curve to maintain or increase their purchasing power relative to the rate of inflation.
That's a self-enforcing loop. So if the perceived rate of inflation nothing drives inflation like inflation expectations. If you think the price of bread is going up 25% tomorrow, you're going to buy 5 loaves tonight.
You're right.
And my point is, and the point we write about, and our point as a team is, this is the first inflationary spike in the history of humankind where social media exists and can proliferate this on a scale and a speed that is unimaginable. So chart after chart, what are you seeing? When we see a GameStop or an AMC or Dogecoin, or pick your favorite, whatever the mania is of the day, we see the speed with which crowds can be mobilized, convinced of something, and induced to act. And what happens when they get mobilized and induced to act on their inflation expectations? So either this is an indirect signal or proof of the direct ability to control it. And the people that control social media today aren't necessarily our friends. It's a scary thought, George. I mean, that's why it's called Doomberg. You don't come to me for the rosy outlook, but it's real. It's undeniable that social media can be manipulated, and inflation expectations feed inflation. And we're in an inflationary spike. And this is the first time ever that everybody involved in this game of inflation expectations is tied to some form of social media.
Yeah, but even if it wasn't manipulated, if you look at the way the algorithm works, and the platforms, what are they trying to do? They're trying to keep you on there as long as possible. Clicks, that's right, views and whatnot. So they're going to just feed you information that they know you'll most likely respond to. So it creates this echo chamber where you start getting into, let's say, Dogecoin or Shiba Inu or whatever, and then you're just getting more and more people saying how it's going to go to 1 million, and then you get the FOMO, and it's just this feedback loop that just continues to take people into areas that are just more and more insane. One thing I wanted to get your opinion on, I just wrote down, is you and Chris especially get more into the weeds than I do as far as actually analyzing the balance sheets and the financials from a lot of these publicly traded companies. Let's just assume for a moment that we would have had that Bitcoin was created in 1997. Mm-hmm. And just for a moment, and I know a lot of people push back on this, but let's just, in this hypothetical world, assume that it became adopted as money. And so we had sound money, and let's assume that the banks wouldn't lend it out in a fractional reserve manner. That let's just assume that it stays at the 21 million. So we've got this sound money system. Well, the Fed wouldn't have been able to do what they did in 2008. Arguably, we wouldn't have had the GFC, but interest rates would be at their normal, 6, 7, 8%, something like that, which most people today can't even fathom. But in that world, in that environment where you've got an 8 or 10% hurdle rate for money going to these new startups, would Hertz exist? Would Tesla, I'll go even that far, would they exist? Would AMC, would some of these meme stuff, or would 70% of the companies that have gone public over the last 3 years that are unprofitable after 10 years of being in business, would they even exist today? Another one that comes to mind is Uber. What do you think?
Yeah, I don't think they would. You're describing what we call the stupid way of analyzing a stock. The stupid way of analyzing a stock is practiced by a group of people that we call money haters. It's all sort of good fun, but in reality, prices of securities today have no reflection back to, by and large, have no reflection back to the present value of future cash flows.
Right.
This is just not how we are valuing securities. And it's not different this time until the thing collapses. But, the quaint thought of a security should be measured by the present value of its future cash flows, corrected for risk with a reasonable terminal value. Those types of companies that are running that way, and the investor relations teams that present those types of analyses to the market, are just not covered. They're not invested in, and they don't move on fundamentals because all the money is chasing the next Doge, chasing the next Avis, chasing the next Tesla, chasing the next AMC. We had a whole series of pieces that we call super stonks, like these stonks that are so crazily valued that they have no hope of ever achieving the present value of future cash flows to compensate for the valuation. AMC was one of them. AMC was a broken company before COVID destroyed its business. Now it's just a meme stonk. It's three symbols on a screen and a bunch of people jockeying back and forth. And in the long run, sophisticated investors will fleece retail. That's what's going to happen with AMC. And that's fine. It is what it is. It happens all the time. It just happens to be happening a lot today. Uber is, Uber, we wrote a piece, Super Stonks Uber. Uber was born out of breaking the law. They just made a decision to break the law in every major city that they went into, and they just ignored the law. And this was sort of regulatory arbitrage. We're going to grow faster and become more popular than you can police us. But it's still a cash losing business. So I've traveled, you've traveled. The last major city I went to, the taxi cab was a fifth of the cost of an Uber. Because they have to price themselves at a point now where if they're truly interested in sort of monetizing the network effect that they've built, it just doesn't work. We wrote about Beyond Meat, which at its apex was worth more than the entire value chain of ingredients that fed it. It's when you look at statistics like that, but it's not a growing company. They just missed quarterly revenues, and the stock is down probably 30 or 40% since we wrote about it. We don't do single stock advice. We just comment on these crazy entities. And back to your question, if we had sound money and companies had to earn their cost of capital to be rewarded in the equity markets, none of these things could exist, which is the whole reason why people like us think that sound money is a good thing. We look very stupid today. That's why we call it the stupid way of, analyzing companies. And back to your point, like we try to earn in fiat, buy real assets, and then invest privately where we know that we can affect the outcome. And the private markets have gone a little crazy as well, but not nearly as sort of insane, at least as what we see at the most frothy parts of the public market. But to be clear, there's a lot of zombie companies that shouldn't exist because we've destroyed the ability for companies to go bankrupt. Everybody needs to be saved. Right. But there's a lot of really good companies that are selling for very cheap in traditional ways that might never go up because nobody buys them. I mean, ultimately price is set between a buyer and a seller, not based on fundamentals. A lot of those companies would do well to just go private and pay themselves a dividend. Because
and let's be clear that it's the big corporations that can't go out of business, but we can completely destroy the small and mid-sized businesses.
Which is why I think the gig economy for brains, where you actually go micro, not small.